Good morning, everybody. As we have so many international guests, so maybe let's conduct this presentation in English, probably will be easier for everybody. So, yeah, this is my picture, so it will be easier to recognize me during the lunch. So, down to the business. I'm here because of my belief in disruption, and this is what I like to talk about today. The digital disruption, how fintech companies as mine and yours are pushing incumbent financial institutions, of course, mostly banks, to change or die. I'd like to tell you a story with three main characters: dinosaurs, meteorite, and rodents. Dinosaurs are the 5,600 incumbent banks and other incumbent financial institutions with more than 17.5 trillion US dollars assets. Rodents are startups. It's 12,000 fintech companies which have raised over 350 billion US dollars in investments till 2018. But the wild card lies with the meteorite. Big tech companies, who are large multinational technology firms such as BAT and GAFA. GAFA stands for, of course, Google, Apple, Facebook, and Amazon. And less familiar for us, BAT stands for Baidu, Alibaba, and Tencent. Does it work? Next one. Okay. Sorry, some technical stuff. Okay. I like to show you the, yeah. So, fintechs and incumbents are busy trying to find ways or to collaborate or to compete on the really changing financial market. But a disaster is on the horizon. A meteorite is crashing down to the earth and will crush everyone, except the smartest of us. Today's environment for them, for banks, is riskier than ever been. As J.P. Nichols said, banks have to upgrade themselves or risk being burned to the ground. Banks and other financial institutions struggle with sluggish innovation, often the result of their legacy IT systems and internally facing culture. Of course, they focus on innovation, but mostly for the most routine customer transactions, online banking, mobile banking, transfers. But marketing, underwriting, and the whole digital servicing still taken a back seat. If incumbents are going to survive the coming wave of rodents, fintechs, they will need finally to take the real digital transformation seriously, as the whole customer journey, also because of the lending business, changed and was redefined by creative and agile fintech solutions. So what is fintech? Too many people, even here in this room, still think that fintech is a buzzword. But fintech uses technology to make finances better. Previously, fintech was mainly used for the back office transactions. But now, fintech has really transformed how banks operate, what we saw two presentations in the past. In the US and Europe, we are really at the tipping point, especially in consumer banking. So banks, they have clients and, of course, cash. But fintechs really have the real innovative edge. In 3 years, fintechs has moved from niche curiosity to the global phenomenon, what we'll see mostly in Asia. American and European banks are facing now, how one report said, their Uber moment, what like taxi industry did several years ago. According to one report which I found last week, 31% of banks' revenue could be at risk from new entrants over just the next 5 years. Another report, in a global study, 96 consumers are aware of at least one money transfer on payment fintech service. And this is interesting. Half of global consumers use insurance fintech service. Now I will show you some numbers that prove that fintech is growing as a financial force. Investment in fintech have grown exponentially since 2010, and in 2018, so last year, only in this year was $111 billion in investments. We can also look how venture capital investments play out geographically. And what we see, that investment splits roughly equally between China and the US, unfortunately, lagging Europe far behind. I'd like to just point out, as I have only 20 minutes, what fintechs are doing today by highlighting the 6 fintech trends disrupting the financial industry now. They are chatbots and messenger-based and obsolescence of bank branches. Here I have the different opinion than my previous speaker. Omnichannel banking and obsolescence of bank branches. Machine learning and AI, of course, for fraud detection. Rapid money transfer. Biometrics. And of course, the blockchain technology, not only for digital transactions, but mostly. But these are only few fintech trends that are really reshaping now the way we see financial services. But in order to achieve a real market penetration, fintechs needs more power behind them. So partnership with traditional financial institutions are the key to exploring a potential of real fintech disruption. But successful partnership between fintechs and incumbents must be based on a mutual respect. As we see, the market valuation of fintech unicorns is only 39 fintech unicorns. Is now $147 billion. There are data from last week. And we see that they start to rival that of Europe's largest banks. Some of banks and incumbent financial institutions really view this as a pure competition. As we see in a recent survey, 2/5 of banks have a negative outlook on the future of financial service space, citing competition to market share with fintechs, disaggregation of banks, lower profit margins as a result of fintech disruption. But what is more important, 56%, so majority of those surveyed, saw collaboration and adding value for everyone towards the future success. In a complementary survey, 73% of banks' CEOs view partnership with fintech companies as the best way to achieve their goals. Fintechs and incumbents, we have a symbiotic set of competitive advantages and challenges. It makes our engagement a win-win solution. Because banks can really take advantage of fintechs agility to launch and pivot quickly, increased efficiency and lower development cost, our laser focus on customer experience, and of course, skills in handling data. But most successful fintech firms now focus on a narrow segment, unserved mostly by traditional financial institutions. But we struggle to scale on our own. That's why fintechs can use incumbents. Infrastructure, mostly distribution infrastructure, brand recognition, economies of scale, and of course, their capital. Because financial institutions, they had a deep pockets and still a vast customer base. But their tired legacy systems still hold them back. That's why, in my opinion, banks and other financial institutions should focus on engagement with fintechs. So let's see the models of engagement. The majority of financial institutions view engagement as a path toward future success, as we saw on these two surveys. But only a quarter of global surveyed banks are really actually engaging day by day with some fintech institutions. Of those, 69% opt for collaboration, 27% choose investment in fintechs, and a mere 4% is exploring merger and acquisition. As many established firms, we see that even in Poland, turn to fintech investment. They invest by easy, pumping money into fintech, hoping to generate the innovative value for their businesses mostly, not to the fintech. Incumbents, in this case, gain early and easy access to innovative solutions and, of course, fresh in-house talents. But the valuation of such a fintech in investment is a pressing problem when you invest in startups without proven track record, without positive EBITDA. So in essence, we could say that this investment is like financial institutions choose a fintech they like and just start throwing in cash, hoping that maybe in future it will generate a value and some money to come out. Under the merger and acquisition model, institutions acquire fintechs to increase, of course, their digital footprint immediately and shortcut the development of new technologies. Incumbents absorb, in our case, with dinosaurs and rodents, we could say, eat fintechs just to get shinier. I see in such cases a lot of PR which incumbents just do by acquiring fintechs. So while some institutions are looking on an investment or merger and acquisition, we have to say that this model is really difficult to pull off. So as we will see, in my opinion, a hybrid model, a collaboration model, is the best way forward. Collaborating implies incumbents use products or platforms developed by fintechs. In the same time, fintechs retain their independent spirit and increase product exposure on the market. Under the collaboration model, traditional firms and fintechs benefit from each other's strengths without losing our respective identities. That's why we don't waste time and energy on competing, just collaborate. Because together we have to utilize, between banks and fintechs, our key strengths to deliver to the market the greater level of personalization, speed, contextuality, seamlessness, just to defend our position against an advancing threat with even more powerful competitors, because it's not fintechs that will change the financial markets in the future. GAFA and PAT, they are the real threat. Big tech companies represent a much bigger threat for banks due to their 5 competitive advantages. Access to a unique real-time information, very large customer base, skills in managing large volumes of data, enormous financial strength, and of course, their innovative infrastructure. Let's look a little bit more deeply. They have access to a unique real-time information on the product, sales, customer satisfaction levels. Firms using their own platforms, they can observe revenue and market structure, estimating the firm's profitability. They also can infer customer preferences and living standards. Such information can be exploited to assess a credit risk for individuals or businesses, a function that is a core of traditional banking. Big tech have, of course, a very large customer base with their amazing customer-centric business model. Large technological firms are more skilled than banks and fintechs in managing large volumes of data, even unstructured data, video, voice, pictures, or behavioral. Big tech have also an enormous financial strength. Yesterday, the valuation of Amazon was $901 billion US. It's 9 times Polish yearly budget. And of course, they have the infrastructure. Unlike fintech firms, big tech have both, as I showed, the massive customer base and a vast cash reserve. So that provides more logical and accessible path for them to scale operations. Let's look at just some examples, indicators of the strength they choose. First, Tenpay, owned by Tencent, proceeds 1.2 billion mobile transactions every day. Alibaba launched microloans. We spoke also about some microloans in China to presentations before. Libra, an amazing project where Facebook bid to remake a cryptocurrency space. And Amazon claims that 3 million customers use Amazon Pay all over the world. This is a great example how Amazon bypass banks. In my opinion, it's only a matter of time before big tech companies make an even more significant impact on the whole financial market space. But then GAFA could have a superior position over both, over traditional financial institutions and over fintech firms. With their amazing focus on customer data, big tech firms could leverage customer trust and high engagement to introduce even more and best products that we offer now. According to EY survey, global consumers, 68% of global consumers would consider a non-financial service company for financial services. As we know, a handful of super firms were able to quickly append a Southeast Asia market, and now is a time for Europe and the US. As banks and fintechs try to build our plans to adapt to customer changing needs, to customer changing market, leaders will anticipate the role big tech firms may play in the future, and we have to start forging partnerships to get ahead of this forthcoming disruption. Because even with the best collaboration models and our ability to compete on the market, in the banking ecosystem, the system will be challenged by the big tech powerhouses. When you examine their strength, you will see the meteorite crashing to the down every of us, banks and fintechs, and it will remake the surface of the earth. Only the best prepared, also of course unicorns, will survive this fallout. That's why, in my opinion, we should focus on a real threat speeding toward us. A quote from Bill Gates, he was today already, he said, "We always overestimate the change that will occur in the next 2 years, but we underestimate the change that will occur in the next 10 years. Thank you very much.